In this presentation, we're going to look at the completion of the consolidated statement of financial position, the group balance sheet. This is the more complicated part of the consolidation process. There are a large number of adjustments that need to be made to the individual company figures appearing in their own financial statements, and we'll go through those one by one, and then we'll have a look at the overall adjustments required to the group statement of financial position. Now, in past exams, the question has usually involved the completion of an entire group balance sheet, but more recently the questions have been more concerned with computing various of the figures that appear in the financial statements rather than the completion of the statement as a whole. And in a future presentation we'll have a look at both of those. We'll have a look at some consolidated financial statement questions, and also some questions involving the calculation of individual figures that appear in both of those statements. So in this presentation we'll start by looking at each of the figures that need adjustment, and then we'll sum up by going through the balance sheet. The one thing that's really important to say is that because of the different ways in which the questions might appear in the exam, it's really important that you get an understanding of why you're making the adjustments, and where the figures come from and what they mean. It's not going to help you to learn mechanically what adjustment to make, because you might get lost in the exam if the questions aren't presented in the way that you're used to. So have a look carefully through this presentation, and then it's important that you do practice these questions. So let's start by having a quick recap of the basics of consolidations and a quick look at a consolidated profit and loss account. Remember that we're only interested in dealing with companies that are regarded as subsidiaries, and that's a company that is under the control of another. Basically more than 50% of the shares, but control can be exercised in other ways, but control is the important word. And so we need to prepare a set of consolidated accounts which incorporate all of the business activities under common ownership. And remember, those financial statements will include all of the profits and all of the assets that are under the control of the parent company, even if the parent company doesn't legally own the whole of those profits, the whole of those assets. Any part of those items belonging to somebody else are reflected in a non-controlling interest figure in the statement of financial position. And if we look at the consolidated profit and loss account, the income statement, the parent and the subsidiary companies' statements are combined to show what they would have looked like if all of the transactions had been carried on by just one company. And that means that all the transactions which wouldn't have been included if both businesses were combined into one, all those transactions need to be cancelled out and eliminated from the figures. We also need to look at goods that have been sold between group companies that are still in stock at the end of the year. Those items need to be reflected in the consolidated profit and loss account, the value to the group of companies, the cost to the whole group, not the price the individual company paid for those items. So here's a quick profit and loss question. The parent company owns 80% of the subsidiary, and during the year the parent company sold goods to the subsidiary for 26,000, which it had originally purchased for 20. So the parent company made a profit of £6,000, and half of those goods were still in the subsidiary company's stock at the end of the year. Now there's the parent company's profit and loss account and the subsidiary company's profit and loss account. See if you can quickly work out what the consolidated profit and loss figures would be, and then how the profit will be split between the group and the minority. And just pause the presentation at this point and see if you can work out those figures. So the first thing we have to do is eliminate the intercompany transaction, both from revenue and from cost of sales. That will give us a consolidated revenue figure of £94,000. We've added the 80,000 and the 40,000, but then deducted the 26,000 intercompany sale that would be included in the parent company's revenue figure. And then as far as cost of sales is concerned, we've got a figure of 57,000. That's the 50 and the 30 added together. We then eliminate the intercompany purchase that will be included in S Limited's cost of sales figure, but we then have to reduce the value of the stock that S Limited still has that it purchased from P Limited. It will currently have that in stock at £13,000. That's the price that it paid P Limited for it, but the original cost of those items to the group as a whole wasn't 13,000, it was only 10,000, and so we have to reduce the closing stock figure by 3,000. And remember, if we reduce the closing stock, that's going to increase, not reduce, it's going to increase cost of sales. So we end up with a cost of sales figure of 57 and a gross profit of 37. The remaining figures in this example simply get added together, and that gives us a profit after tax in the group of £12,600. We then have to show how that profit's shared out between the group and the subsidiary company minority shareholders. Do remember that the minority shareholders are only entitled to a share, in this case 20%, only entitled to 20% share of the subsidiary company's profits, not the profits of the total group. So in this case, the minority are entitled to 20% of the subsidiary company's profit of 2,100. The remainder of the profits belong to the group. And remember, we don't need to adjust this time the subsidiary company's profit because of the stock valuation adjustment, because the £3,000 unrealised profit that we've added back to cost of sales, that was originally reflected in the parent company's profit and loss account, not in the subsidiary companies. If the sale had been the other way around, then we would have had to deduct the £3,000 from the subsidiary company's profit, which would have ended up with a loss in that case. Let's look now then at the calculations that we'll need to carry out in order to produce a consolidated statement of financial position. And it's really important to understand what it is we're doing when we make these adjustments, not just to be able to carry out the calculations, because they're likely to be presented to you in more than one way. So we'll have a look at the calculations item by item. So just remember a few basics about the balance sheet. The consolidated statement of financial position shows the assets and liabilities that are under the control of the parent company, not necessarily legally owned by but controlled by the parent company. If some of those assets are legally owned by someone else, then that value is reflected in a minority interest figure or non-controlling interest figure that's included in the equity section of the statement. And so what we're doing really is replacing what would appear as a single investment figure in the parent company's own accounts. We're replacing that single figure with the underlying assets and liabilities that that investment represents. And an important thing, as we will see in a few moments, those assets and liabilities are included at the cost to the group and not at the original cost to the subsidiary. That's an important point to remember, that the values that we include in the balance sheet are the historic cost to the group, not the historic cost to the subsidiary company. And again, as with the profit and loss account, any intercompany balances in the year end are eliminated. If there are loans between the companies, there will be an asset and a liability that both need to be cancelled out. If there's an intercompany sale, then there'll be a receivable and payable figure that need to be cancelled out, and so on. Now, by way of illustration, here's a very simple example where a parent company has purchased a subsidiary company, purchased all of the shares, so it's 100% of the share capital is owned, and the parent company purchased the subsidiary for £50,000, and these are the balance sheets of the subsidiary and the parent company immediately following that acquisition. And you'll see that in the parent company's balance sheet under non-current assets, we've got an investment in subsidiary figure of 50,000. And if you look at the subsidiary's equity section, you'll see that that also comes to £50,000. That implies, firstly, that the assets in the subsidiary company's balance sheet reflect their current values, and that the subsidiary hasn't carried on any trading after the acquisition at this point in time. So in this case, we would simply eliminate the investment in the subsidiary figure, and we also get rid of the equity section of the subsidiary. And then we simply add the two companies' figures together, remembering to eliminate any intercompany transactions. And you'll see at the top of the slide we're told that there are intercompany balances of 11,000. So in one of the company's trade receivables there will be an £11,000 item, and that's matched with an 11,000 item in the trade payables figure of the other company. So both of those, the receivables and the payables figures, need to be reduced. And if we make that adjustment and then we simply add the figures together, we'll end up with the consolidated statement as shown there. So the investment in the subsidiary figure of 50,000, that's been eliminated, and that's been replaced by the individual assets and liabilities of the subsidiary, which at this point in time add up to that 50,000. We've eliminated any intercompany balances from both receivables and payables. And here's the most important thing for you to remember. We'll give you some easy marks in the exam, and it's this: the only share capital and share premium accounts, if there is a share premium account, the only ones that appear in the consolidated statement are the parent company's share capital and share premium accounts. Now, in the exam, it's extremely unlikely that you're going to be presented with a pair of balance sheets that are that simple and straightforward to put together. Here's the situation you're more likely to encounter if you're asked to prepare a complete statement of financial position for the group. And you'll see here that the investment figure in the parent company's balance sheet is 26,000, but if we look at the subsidiary company's equity section, that comes to 33,092. So if we cancel out this time the the investment figure and the subsidiary company's equity section, and we merge together what's left, then the balance sheet won't balance anymore. There'll be an imbalance between the net assets and the total equity. Now, the reason for that difference is probably due to several things. Firstly, it could be that the amount paid for the shares reflects the market value of subsidiary company assets, which are shown in the subsidiary company's balance sheet at historic cost. That's one reason why there could be a difference. Secondly, it may be that since the subsidiary company was purchased by the parent company, it's continued to trade and has made additional profits. It could be because the parent company doesn't own all the shares in the subsidiary, less than 100%, and it could also be because the price that the parent company paid to acquire the shares reflects a payment for goodwill, which, if you remember your accounting standards, cannot be shown as an asset in the subsidiary company's own statement of financial position. Now, each of those items requires adjustment to the statement of financial position figures, and if you're asked to prepare a full consolidated balance sheet in the exam, the chances are that all of those adjustments listed there will to some degree be required to be taken account of in the exam question. And later on in another presentation, I'll probably look at a couple of exam questions and work through those as examples. So let's have a look at each of these adjustments so that you understand why the difference arises, and also the adjustments that will be required to the consolidated statement of financial position. So we'll look at each of those adjustments in detail now, and then when we've done that, I'll run through the statement of financial position basically from top to bottom, looking at the adjustments that you'll probably be required to make to each section of that statement. Now, one reason why the figures might not balance in the statements is because in the subsidiary company, assets are shown at their original historic cost. And here's an example of the subsidiary company showing assets in its statement of £50,000. Now, that's the historic cost of assets, and at this point in time, those assets are worth a total of £70,000. So there's a £20,000 increase in value that isn't reflected in the balance sheet figure. If the company sold all of those assets at the present time, then the result would be a bank account with a balance of 70,000 in the bank. Now, if another company comes along and wants to buy all the shares in S Limited from the existing shareholders, then those shareholders, if they've got any sense, won't be happy to sell the company for the balance sheet value of 50,000. They'll want to receive a payment that reflects the current market value of assets, which is £70,000. So when P Limited wants to buy S Limited, the minimum amount that the existing shareholders are going to want is £70,000, not the £50,000 shown in the balance sheet. It's a mistake that a lot of people that are looking at buying existing businesses make. They tend to assume that the balance sheet value reflects what the business is currently worth. And because very often there are assets, particularly land and buildings, in the balance sheet that are shown at historic cost and are now probably worth considerably more than that, it's in fact correct to say that the balance sheet value of the business reflects the absolute minimum amount that a potential purchaser would have to pay, and the actual figure would probably be quite a lot more than that. So anyway, in this case, P Limited, if it goes ahead and buys S Limited, the minimum amount that the shareholder would want is 70,000. If we draw up a set of accounts after the purchase, the net assets in the subsidiary company's statement of financial position will still show a total of £50,000. But in the parent company's balance sheet, the investment figure will be £70,000. That's the amount that the parent company has paid. And so again, we've got an imbalance there. If we cancel out the investment in subsidiary figure of 70,000 and replace it with the net assets of S Limited that come to 50,000, then again we've got an imbalance, and the statement of financial position won't balance out. The assets at the moment are shown in S Limited's statement at the historic cost to S Limited, what S Limited originally bought them for. What we need to do in the consolidated statement is show the assets at the cost to the group, not the cost to S Limited, but the cost to the group, the amount that P Limited had to pay for them. And that's £70,000. So we need to make an adjustment. And in the consolidated statement, the difference between the balance sheet value of the assets and their market value, that difference needs to be added to the asset values when we're producing the consolidation. And that's referred to what's called a fair value adjustment. It's an adjustment so that the figure in the consolidated balance sheet represents the cost to the group of those assets, not the original cost to the subsidiary company. Now there's one point to remember there. Although we're effectively revaluing the assets of the subsidiary to market value at the date of purchase, that doesn't mean that we're obliged to carry out any future revaluation after that, because we're actually showing them at historic cost as far as the group's concerned. So just have a quick look at this example of that. we've got a parent company, P Limited, buying 75% of the shares in the subsidiary company, S Limited. And at the date that the parent company purchased those shares, the subsidiary company had property, plant and equipment in its balance sheet shown at a value of £180,000. But when the parent company, P Limited, purchased those shares, that equipment had a current market value of £220,000. And it would be that current market value that would be taken into account when calculating how much P Limited should pay for the shares in the company. Now, at the moment, at the year end, in the individual company balance sheets, P Limited is showing property, plant and equipment of £480,000 and S Limited is showing property, plant and equipment at £300,000. Now, just pause the presentation for a moment, have a look at those figures and just see if you can work out quickly what the property, plant and equipment figure in the consolidated statement of financial position will be based on those figures. So we first of all add together the two balance sheet figures from P Limited and from S Limited, but we've then got to make an adjustment, and remember that's termed a fair value adjustment, which is equal to the difference between the balance sheet value of the assets at the date P Limited acquired its 75% and the market value of those assets at that date. So that's the difference between 220,000, which was the market value, and 180,000 that was the balance sheet figure. So that means we add on an extra £40,000 to property, plant and equipment in the consolidated balance sheet, and so we'll be showing a total of 820,000. And remember, that reflects the cost to the group of the assets purchased rather than the original cost to the subsidiary company. Remember also that we're showing the full value of those assets because we're including all of the assets under the control of P Limited, not necessarily owned indirectly by P Limited. P Limited only owns 75% of that £820,000 of value, or at least the £340,000 rather, just the subsidiaries value. We only own 75% of that. But 820,000 is the figure that will appear in the consolidated statement. Now, one thing I just want to mention that's not going to crop up in the exam, but you need to be aware of it if you encounter consolidations in a real world situation. Because we've changed the value of the subsidiary company's assets in the consolidated balance sheet, so that at the date of acquisition the value has been changed from 180,000 to 220,000. Although we've increased the asset value, we haven't increased the depreciation charge. The depreciation is still being calculated on £180,000. In a real world consolidation situation, you would need to make an adjustment to the depreciation charge so that it was calculated on a £220,000 figure rather than a £180,000 figure. But that's something that won't be required in the exam. If a question crops up with these adjustments, then normally you'll find a brief sentence that tells you that no adjustment to depreciation is required. So you'll at least understand why that note is there now. So we've seen how different asset values could affect the figures in the individual balance sheets. Another reason why the equity and investment figures might be different is because the subsidiary company has made profits from trading after the date that we acquired the shares. Now, any retained earnings up to the date of acquisition of our share in the business, those retained earnings are reflected in the price that we've paid for the shares, and they're cancelled out as part of the consolidation process. But any retained profits made since the date of acquisition, those profits are added to the parent company's retained earnings in the consolidated statement, assuming we own 100% of the subsidiary company. If we own less than 100%, then our share of those post-acquisition profits gets added to the parent company's retained earnings. The balance of those post-acquisition profits gets added to a separate figure that represents the amount owed to non-controlling minority shareholders in the subsidiary company, which appears as an extra item in the consolidated statement. So here's an example of the calculations required. In this case, we've got 80% of the subsidiary company. Now, in the exam, you'll be told what the current retained earnings figure in the subsidiary company's balance sheet is, in this case 30,000. You'll also be given a figure for what the retained earnings were at the date of acquisition. Now, those retained earnings get cancelled out. The retained earnings made after the date of acquisition are treated differently. Now, clearly, if the current retained earnings are 30,000 and at the date we bought the shares the retained earnings were 18,000, then the post-acquisition profits will be the difference between those two, and that's a figure of £12,000. So that's profits that have been made since the subsidiary company came under the control of the parent company. Now, because we only own 80% of the subsidiary in this example, then we're only entitled to an 80% share of those profits, and so only £9,600 will be added to the parent company's retained earnings in the equity section of the consolidated statement. The remainder of the profits, £2,400, will be added to a separate figure that represents the amount owed to the minority shareholders in the subsidiary. So just have a quick look at this question. P Limited, that's the parent company, has purchased 70% of the subsidiary some time ago. At the time of purchase, the retained earnings in S Limited were £30,000, and at the current year end, S Limited's balance sheet shows retained earnings of £66,000. So just see if you can now pause the presentation and work out the three figures for this question, what the post-acquisition profits are, how much of those gets added to the parent company's retained earnings in the consolidated statement, and how much gets added to the non-controlling interest figure in the consolidated statement. So the post-acquisition profits will be the difference between those two figures, the current figure and the figure at the date that we acquired the shares, and that will always be provided for you in a relevant exam question. Remember, the 66,000 is the current figure. That includes what's already been made when we buy the shares. So the difference between those two The 36,000 represents post-acquisition profits. Now, we own 70% of the company, so we're entitled to 70% of those profits, and that's the amount that will be added to the retained earnings figure in the equity section of the consolidated statement. The remaining 30% will be added to the non-controlling interest figure that also appears in the equity section. Now, the third reason why the investment and subsidiary equity figures aren't the same is because perhaps the parent company hasn't purchased the whole of the share capital of the subsidiary. In this example, S Limited has got assets in the balance sheet that are at their market value of £80,000, and this time the parent company doesn't want to buy the whole of S Limited. It only wants to buy a controlling interest of 70%, so it will still have control, but it won't own 100% of the shares. Now, if it only wants to buy 70% of the share capital, that means that legally it owns indirectly 70% of the assets. Now, assuming there's no payment required for goodwill, the shareholders in S Limited would want £56,000 from P Limited for that 70%. The remaining shares, the remaining 30%, will be owned by other shareholders. The minority interest, usually referred to as non-controlling shareholders. They only have a 30% share, and so they don't have control of the company. Now, in this case, the net assets in S Limited's statement will come to a total of £80,000, but P Limited's investment will be shown in P Limited's statement at only £56,000, so there's a difference there, and that's because of the 30% owned by the non-controlling shareholders. Now, remember, in the consolidated balance sheet we show the whole of S Limited's assets because we're showing assets under our control, not assets owned by the parent company. So if we think of it as a double entry, then we're going to cancel out the investment figure in the parent company, so that £56,000 will disappear. We're then going to add into the balance sheet all of the assets and all of the liabilities of S Limited, and that's going to give us a total of £80,000. The difference between those two figures now gets credited to a non-controlling interest account in the equity section of the consolidated balance sheet. If you remember from the previous example, that's the account that the non-controlling interests share of post-acquisition profits go to as well. So that's a new account in the equity section for the non-controlling interest. Now, the last and most important reason why the figures in the subsidiary and the investment figure don't agree is because payment has been made for goodwill. Here we have S Limited, whose assets shown in the statement of financial position have a market value of £80,000 net assets. However, S Limited has been running the business for a long time. It's built up a lot of customer loyalty, it gets repeat orders, it's got a good reputation in the marketplace. Now, if P Limited comes along and wants to buy S Limited from the existing shareholders won't be happy with just the £80,000 balance sheet asset value. They'll want a payment for the business's reputation, the customer loyalty, the brand awareness, and that's what's termed goodwill. And let's say in this example the shareholders want a total of £120,000 from P Limited in order to sell the company to P. Now in this case, if we look at the individual accounts, the net assets at market value in S Limited's statement will be £80,000. The investment figure in P Limited's statement will be 120,000, and clearly there's a difference there. Now if you remember from IAS 38, intangible assets, S Limited can't show the value of the goodwill in its own statement, because until this sale takes place the value of the goodwill can't be accurately determined. So in this case, when we cancel out the two figures, we've now got to include that missing figure for goodwill, because now P Limited has actually purchased the goodwill from the existing shareholders of S Limited, and it's paid £120,000 in total, which means it's paid £40,000 for goodwill. So now IAS 38 doesn't apply, because the cost of the goodwill can now be accurately determined. We've actually got a figure put on it that P has paid, and so we now, in the consolidated statement of financial position, we can include that goodwill figure that was missing from S Limited's statement. Now the goodwill calculation is something that in the exam gains high marks. Occasionally in the exam you won't have to prepare a consolidated statement of financial position. Sometimes you will only be expected to calculate the goodwill. So it's an important calculation to make sure you can do. Now the definition of goodwill is a straightforward one. It's the difference between the market value of the assets that have been acquired that are in S Limited's, if you like, the subsidiaries' financial statements, and the price paid. So if we think about the previous example, it's the difference between the £80,000 that's the balance sheet total of assets with the price paid of £120,000. So in that example the goodwill was £40,000. Now to calculate the goodwill we need to know a number of things. Firstly, we need to know the market value of the net assets of the subsidiary at the date we acquired the shares, and remember the net assets minus liabilities is equal to the total equity. That's the old accounting equation. And so rather than try and determine the individual assets and liabilities that existed in the subsidiary at the date of purchase, it's always easier to work out what the total of the equity section of the balance sheet would have been at that date. And so it's always easier to arrive at the total equity, because that's the same as the net asset figure. We also need to know if there's any difference between the balance sheet value of the subsidiary company's assets and the market value of those assets at the date of purchase. We're not interested in the current market value at all. What we want to know is how much those assets were actually worth at the date that the shares were purchased by the parent company, so that we can work out what the value of the subsidiary was at the date of purchase. And finally, we need to know the percentage of the company that's been purchased if it's less than 100%. Now, once we know all that information, and we know from the investment in subsidiary figure in the parent company's balance sheet the price that was paid for the subsidiary, we can now calculate the goodwill. And there are a number of different ways of calculating the goodwill, so don't get confused. It's important that you understand what the calculation is. Go back to that definition, the difference between the market value of the assets acquired, whether it's 100% or 30% or 50%, the market value of the assets acquired and the price paid. That's what we're trying to calculate. Once you understand what we're doing with the calculation, then you can cope with the various ways in which the figures might be presented to you. So here's an example of the goodwill calculation. We've got a company here, P Limited, the parent company, and P Limited purchased 80% of the shares in S Limited some time ago for £280,000. And at that point in time, the retained earnings figure in the equity section of S Limited's statement of financial position was £45,000. And we're also told that at the time the shares were purchased, some of the assets in the subsidiary company's statement that were included in the accounts at a figure of £30,000 were at that date worth £85,000. Now, with all of that information, we can calculate the goodwill. But there's one missing thing, and it's the share capital figure. Now, we want to know the share capital. We want to know, in fact, the total equity figure in S Limited's accounts at the date of purchase of the shares. Now, usually in the exam, you'll be given the current balance sheet of S Limited, which might show these figures for share capital and retained earnings. And usually in the exam, you will be told that the share capital figure hasn't changed since the date that P Limited acquired 80% of the company. And so when we construct the equity total of S Limited at the date of purchase, we can usually use the current share capital and share premium figures that are shown in S Limited's current statement of financial position. So now we can carry out the calculation. First of all, we need to know the net asset value of S Limited at the date of purchase, and that will be the share capital of 100,000, because we know that hasn't changed since the date of purchase, so we can use the current figure. And we need to add on to that the retained earnings, not the current figure, but the retained earnings as they were when we purchased our 80% of the company. And that's the figure that's always given to you in the detail of the question, and we can see here that it's 45,000. So that's what the equity section would have shown at the date we purchased the shares, £145,000, and that's equal, as you remember, to the net assets. We then need to add on to that any difference between the market value and the balance sheet value of the assets at the date of purchase. And we've seen here that in the detail of the question, at the time of purchase, assets in S Limited that were recorded at £30,000 were valued at £85,000. So included in S Limited's accounts were assets that were actually worth £55,000 more than the balance sheet value. And that's the fair value adjustment that we looked at previously. That needs to be added on to the net asset figure. So that gives us a total of 200,000. That's the market value of all of the assets included in S Limited's accounts at the date of share purchase, net assets at that date, 200,000. Now the next thing we need to do is to deduct the part of those assets that we haven't indirectly gained ownership of. We've only purchased 80% of the shares, so that means we're only entitled to 80% of the assets of S Limited. And so 20% of the assets belong to somebody else. That's the non-controlling interest in the assets of the subsidiary at the date of purchase. So we need to deduct the value of the assets that belong to somebody else. That's 20% in this case, leaving the assets that we're now indirectly owning, which are worth at the date of purchase of the shares £160,000. If we then compare that value with the price paid, then the difference, and remember that's the definition in IFRS 3, the difference between the value of assets acquired and the price paid, that's the goodwill figure, which in this case is £120,000. So that's the steps that we need to take to calculate the goodwill. First of all, work out what the balance sheet total of the subsidiary company would have been at the date of acquisition. Make an adjustment if any of the assets in the balance sheet were worth more than the recorded figure, and then make a deduction if we've acquired less than 100% of those assets. Then compare that figure to the price paid, and the difference is what will be accounted for as goodwill. Now here's a second example, and we'll do the calculation this time in a slightly different way. In this case we've acquired 60% of S Limited, so we still have control, and we paid £190,000 for 60% of S Limited's shares. The retained earnings in the balance sheet at the date of acquisition were £45,000, and at the time we bought the shares, some of the assets in the statement were recorded at a value of £70,000 when they were actually worth £108,000. And we're given the current statement of financial position for S Limited, which includes share capital of 200,000 and retained earnings of 85. And again, we're told that the share capital figure hasn't changed since the date the shares were acquired. So we can now calculate the goodwill from that information, but this time we start with the price paid, which was the £190,000, and then we add to that the value of the minority interest, the non-controlling interest in the subsidiary company at the date of purchase. So we need to work out what that value was. So the share capital 200,000 plus the retained earnings at the date of acquisition 45,000. Don't make the mistake of using the current 85. So share capital at the date of acquisition plus retained earnings at the date of acquisition plus the fair value adjustment to reflect the fact that assets in the statement were worth 38,000 more than the recorded figure. So those three items added together give us the value of S Limited at the date we acquired our 60%. So 40% of that value, 113,200, belongs to someone else. If we add those two figures together, the 303,200 represents the total value of S Limited at the date of acquisition plus the value of goodwill that we've purchased. So if we now deduct from that the total value of S Limited, that's the 200 plus the 45 plus the 38, the difference will give us the goodwill figure of £20,200. Now you might have calculated it in a different way. Incidentally, that 113,200, the non-controlling interest share of the company, that's a figure we're going to need later on. We'll come back to that. But that's a different way of calculating it. If you calculated it in the way shown previously, then there are the figures that you would have. In this case, we work out the net assets of the company at the date of acquisition, add on to that an adjustment to take account of the market value of assets at that date. That gives us 283. We deduct from that the part of the assets that we haven't purchased. That gives us a figure of 169,800, representing the value of assets included in the subsidiary's balance sheet at the date of purchase that belong to us. If we compare that to the price paid, then again we come back to the 20,200 goodwill figure. So it doesn't matter which method you use to calculate the goodwill. The important thing is obviously that you come back to the right figure at the end. So here's a question for you to try calculating the goodwill. P Limited has this time acquired 60% of S Limited for £400,000, and at the date of acquisition, S Limited's statement of financial position showed retained earnings of £75,000. Included in S Limited's balance sheet were assets at a net book value of 210,000 that were actually worth at that date 320,000. The current statement of financial position of S Limited shows share capital, share premium and retained earnings totaling 325,000, and as usual there's been no change in either the share capital or the share premium figures since the date our 60% was purchased. So with that information, see if you can now calculate the amount of goodwill that P Limited has paid when it acquired the shares. So pause the presentation for a moment and see if you can work out that goodwill figure. So we start off with the net assets of S Limited at the date of acquisition, and remember net assets equals equity, so we actually work out the equity total at that date. So we've got the share capital of 180,000 plus the share premium of 25 plus the retained earnings at the date of acquisition, and that's the 75,000 included in the question. So that's what the statement of financial position, the total would have shown at the date of acquisition, 280,000. We then need to make an adjustment because some of the assets were undervalued in that statement. They were actually worth 320,000, but in the statement they were shown at 210. So to get a current market value for S Limited, we need to add on a further 110,000. That gives a total of 390. That was the market value of S Limited at the date of purchase, ignoring goodwill. We haven't purchased the whole of S Limited. We've only purchased 60%. So we've only acquired 60% of title to those assets. So we now have to deduct the 40% that belong to somebody else, to the non-controlling shareholders. That gives us a value of assets that we've acquired legal title to indirectly at 234,000. The price we've paid to acquire the shares is 400,000. The difference between the two is the amount that we've paid for goodwill. So it doesn't matter which way round you've done the calculation, as long as you end up with the 166,000, that's the important thing. Now, as I've said before, there are different ways in which the goodwill calculation can be laid out, and it's really important that you don't get confused in the exam, because the workings section of the exam answers gives you the opportunity to lay it out in a particular way that you're not familiar with. So let's just run through 3 of the options that you might come across for calculating the goodwill. Now, the first option takes the price paid, that's P in this little equation that I've shown here, and we deduct from the price paid the net asset value of the company purchased at the date of acquisition, plus any fair value adjustment, and we deduct from that the share of the company that belongs to somebody else, the non-controlling interest. So balance sheet total, net assets plus fair value adjustment minus the non-controlling interest, that gives us a figure for the net assets acquired. We compare that to the price paid, and that gives us the goodwill. So we start off with the price paid, and then we deduct from that the share of the company that we've acquired, and that gives us a goodwill figure of 20,000. The second way of doing the calculation would be to take the price paid and add on to that figure the value of the non-controlling interest, and then deduct from that total, which represents the total value of the subsidiary, deduct from that the net assets plus the fair value adjustment of the company. That will give us the goodwill. So price paid 140, add on the minority share this time of 30 to give us a total of 170,000. Deduct the market value of the assets in the balance sheet at the date of acquisition, which is 150,000, gives us the 20,000 goodwill. And the third option, we take the net assets in the balance sheet, 130,000, add on to that the fair value adjustment of 20,000. That gives us a total value of the company at the date of acquisition. Deduct the part of the assets that we haven't acquired title to, that's 20%, and compare that to the price paid, and that will give us a negative, which we ignore, a negative of 20,000, and that's the goodwill figure. So it doesn't matter how you lay out the calculation, and my recommendation would be to find a way of doing the calculation that suits you, that you understand, and stick to that. In the exam, work out the goodwill on some scrap paper. Don't bother about the space in the exam that's given for workings. You can fill that in later if you want to, but if it's not laid out in a way that you're familiar with when it comes to calculating goodwill, ignore it. Use the calculation that you know, and make sure that you calculate the right goodwill figure. Once we've calculated the goodwill figure, the final thing we must do is consider whether there's been any impairment of goodwill. If you remember, goodwill isn't amortized every year. It's considered to have an indefinite life once it's been created. So there's no automatic write down of the goodwill figure. However, because that's the case, then under IAS 36 we must carry out an impairment review of that goodwill every single year. Remember, most assets only require an impairment review when the directors know or should have known that there's likely to have been a fall in value. That's not the case with goodwill. An impairment has to be carried out every single year. Now, if the directors have considered that the value of goodwill has been reduced, then you need to make a final adjustment to that goodwill figure in the statement of financial position. It needs to be reduced by the amount of the impairment, which will be given to you in the exam either as a percentage or as an actual figure. And we've got to have a double entry. If we're reducing the value of that intangible asset, then the reduction also needs to be deducted from the retained earnings of the group in the equity section. So if you reduce the goodwill on account of impairment, you need to remember later on in your calculation of the consolidated statement of financial position to deduct the same amount from the retained earnings figure that goes into the consolidated statement. One thing to be aware of is that goodwill that we include using these calculations only represents the goodwill purchased by the group, by the parent company. It doesn't include the value of any goodwill attaching to the shares held by the minority shareholders. That's usually ignored in the consolidation process, but if it were to be included, then clearly part of the reduction in the goodwill figure would be charged against the minority interest figure in the equity section and not retained earnings. But don't worry too much about that final adjustment. What I now want to do is to work through the statement of financial position effectively from top to bottom, looking at each section of that statement and all of the adjustments that will be required in order to prepare the consolidated statement. So if we look first at the non-current asset section of the statement of financial position, property, plant and equipment, the first thing we need to do is to add together the separate figures in the subsidiaries and parent companies statements of financial position. But once we've done that, we need to add on a further figure to take account of any fair value adjustment that was required when we calculated goodwill. Remember, that's the difference between the market value and the book value of the subsidiary's assets at the date of acquisition. We're not interested in any market value after that date. It's the market value at the date of acquisition, because that's the cost. That's the cost of the items to the group. So those figures added together will give us the property, plant and equipment figure in the consolidated statement. The investment in subsidiary figure that's in the parent company's balance sheet will disappear altogether. And instead of that, we need to include a new figure for goodwill that we need to have previously calculated. And finally, we need to check to see whether there's been any impairment of that goodwill. If that's the case, then we need to reduce the value of the goodwill, and remember particularly that later on we'll need to deduct the same amount from the retained earnings figure when we come to the equity section. If we then move on to current assets, the trade and other receivables figures, usually those can just be added together, but remember we need to eliminate any intercompany balances that are included in the individual accounts at the end of the year. We also need to make an adjustment if there happen to be any missing transactions. For example, there might have been a sale from the parent company to the subsidiary, that the parent company is recorded in its financial statements, but the subsidiary hasn't received the invoice, hasn't recorded it yet. In that case, we need to adjust the subsidiary's accounts, so any missing transactions would need to be taken account of. But normally the only adjustment that you would need to make to the trade and receivables figure is to deduct any intercompany balances. When it comes to inventory, then again we add the two figures together, but if you remember from the time we looked at the consolidated profit and loss account, there might need to be an adjustment if any of the stock has been included at more than the cost to the group, and those unrealized profits need to be deducted from the closing inventory figure that appears in the consolidated statement. Remember, that amount's been added to the cost of sales figure in the profit and loss account. When we come to the consolidated statement of financial position, we have to remember also that if we're reducing that inventory figure, we've got to make a double entry in the consolidated statement, and if the unrealized profits that we're eliminating were profits that were reflected in the parent company's statement of financial position, then the whole of that adjustment gets deducted from retained earnings. If the profit that we're eliminating was reflected in the subsidiary company's statement, then part of the adjustment will be to retained earnings, part of the adjustment will be to the non-controlling interest figure. Cash and bank balances just get added together. Just watch out if there are any missing transactions that you need to adjust the accounts for. That's unlikely to occur, but just watch out for that. Liabilities then, very few adjustments really. All current liabilities can be added together. The only thing you're going to need to make an adjustment for are any intercompany balances. So you'll need to eliminate those, which will reduce the trade and other payables figure, and that adjustment will match the deduction that you made to the trade and other receivables figure earlier on. So once that's done, then it's unlikely that any other adjustment will be required, either to current liabilities or long-term liabilities. They can just be added together. And that will give you the top half, if you like, the net asset figure of the group of the consolidated statement. It's fairly straightforward. The difficulties now come with the accounts that appear in the equity section, and that's what we'll now take a look at. Now, the share capital and share premium accounts that appear in the consolidated statement of financial position, as I've said earlier on, easiest marks to gain in the consolidation if you remember this one important thing. The only share capital and the only share premium accounts included in the consolidated statement are the share capital and share premium accounts of the parent company. That will always be the case, and it's the first figures that you can put into that consolidated statement. The share capital and the share premium, just the figures from the parent company's statement. No other share capital and share premium figures ever appear. All the other share capital and share premium accounts are ignored in the consolidation process. They are effectively cancelled out. The next figure that we need to calculate in the equity section is the retained earnings figure, and this is made up of a number of adjustments. We start off with the parent company's retained earnings figure straight from the parent company's statement of financial position. We then add on to that the group's share of the subsidiary's post-acquisition profits. Remember, that's not the retained earnings figure in the current statement of the subsidiary. It's the difference between the current retained earnings and the retained earnings at the date of acquisition of the shares. That figure is always given to you. So it's the group's share of post-acquisition profits that get added to the retained earnings in the parent company's statement. But we then potentially need to make some adjustments. If we've written down the value of goodwill because of an impairment adjustment, remember the same amount needs to be deducted from the retained earnings figure. And if we've made an adjustment to the inventory value because of an unrealized profit, then that needs to be deducted from the retained earnings as well. Remember, if the profit that we're eliminating was originally made by the parent company, then the whole of that stock adjustment will be deducted from the retained earnings figure. If the profit that we're eliminating was made in the subsidiary company, then part of the adjustment will be deducted from the non-controlling interest figure rather than retained earnings. But either way, all or part of that adjustment needs to be deducted from retained earnings, and that will give us the retained earnings figure that goes into the consolidated statement in the equity section. The last figure that we need to include then in the equity section of the statement is the amount for the non-controlling interest, the minority shareholders in the subsidiary company. And that figure will be made up of the following. Firstly, the minority's share of the subsidiary company at the date of acquisition, and you will have already calculated that in the course of calculating the goodwill that the group have paid for. So we will already have that figure calculated. So the minority share of the subsidiary at the date of acquisition, and we then add on to that the minority share of those post-acquisition profits. Remember the difference between current retained earnings and retained earnings at the date of acquisition, multiplied by whatever percentage the non-controlling shareholders have. And we might then need to make a deduction for the adjustment to stock value if the profit that we're eliminating was made in the subsidiary company, because then part of the adjustment, a percentage of the adjustment, will be made to the non-controlling interest figure rather than retained earnings. And that will then give us the non-controlling interest figure that will go into the equity section of the consolidated statement. So just to summarize the adjustments that are required to that consolidated statement, non-current assets, we add the two individual figures together, but we then add on to the balance sheet figures any fair value adjustment that's required if the assets in the subsidiary were worth more than their stated value at the date of purchase. We eliminate the investment in subsidiary figure, that disappears altogether, but we replace it with goodwill, and if necessary we deduct any impairment loss that will then be reflected in a reduction in retained earnings. Current assets, we need to reduce the stock value if there are any unrealized profits that we've got to eliminate, and We then deduct from the trade receivables figure any intercompany balances that are included that wouldn't be there if we were dealing with just one company. Current and long-term liabilities, again, eliminate any intercompany balances, unlikely to be any other adjustments. That's the top half of the statement. And then in the equity section, share capital and share premium, do remember it's just the parent company's share capital and share premium figures that get carried across. Retained earnings will be the parent company's retained earnings figure from their statement, plus a share of the post-acquisition profits minus any stock adjustment or goodwill write-down. And then finally, the non-controlling interest will be a share of the subsidiary's value at the date of acquisition of the shares by the parent company. That will have been calculated as part of the goodwill calculation. And then we add on to that the minority share of the post-acquisition profits and deduct any stock adjustment if it was the subsidiary company that sold the goods to the parent company. So the profit we're eliminating was in the subsidiary company. So that's a brief summary of the adjustments that you need to make to the consolidated statement of financial position.